In this video, I'll discuss how to make money by writing covered call options, and we're starting right now. Hey guys, Elliot here. So if you're an active investor, you've probably heard of options and maybe even dealt with them. In general, they're fairly advanced and risky investing, speculating, and hedging tools. However, among all the various types of options you can deal with, writing covered call options is considered the least risky and a good way to pull in some extra income into your portfolio. Coming up, I'll do a quick rundown of what options are, then discuss what covered call options are all about, and conclude with some practical advice on how to use this approach to generate some cash. So let's get into it, and as always, if you enjoy this video and find it useful, please consider subscribing to the channel. Helps me out a lot, and don't forget to smash that like button. Before you can discuss the specifics of covered call options, you need to understand options in general. Here's a brief summary for those that may have heard of them but don't really know all the details. Options are derivative financial instruments and exist hand in hand with the underlying securities, which for our purposes is just regular stock. So an option is nothing more than a contract that gives the buyer of the option the right, but not the obligation, to purchase a set amount of shares of a given stock at a certain agreed upon price by a certain date. That was a bit of a mouthful, but the whole idea, for our purposes here at least, is that options are just really a bet on the price movement of the stock in question. For example, if you think that Microsoft stock, which is currently valued at about $341, will go up to $350 in a month, you can purchase an option contract to buy the stock for $345 before the end of the month. Well, as the month comes and goes, if the share price stays exactly where it is at $341, your option will expire worthless because you sure as heck are not going to buy those shares for more than they're worth. And you're certainly under no obligation to do so. Meanwhile, the seller of the option contracts will walk away pocketing the premium that you paid them, so you lose a little bit of money. Now let's say the price does shoot up to $350 just as you were predicting. Well, you can then exercise those options and purchase those shares at the discounted price of $345, as the option writer does have the obligation to sell those shares to you at that price. You can then either keep the shares or turn around and sell them at the $350 market price, pocketing the difference, minus of course the cost of the option premiums, which the seller will get to keep no matter what. So as you can see, one can buy option contracts or also sell them, which is called writing them. In the Microsoft example I just presented, you were the buyer, but somebody else was the seller, and they did the writing. Now, regardless which side of the fence you're on, you can bet that the underlying security will go up, and that is called a call option, or you can bet that the price will go down, and then that is a put option. So what does covered mean? Well, let's go back to the seller for a moment. Covered simply means that the owner owns the appropriate amount of shares that he or she is writing the option contracts against. If they didn't, it would be called a naked option. And that's not a position most sellers would like to be in, as they would have to purchase the shares at the higher price, no less, if they lose the price bet that I described earlier. That, in essence, is a highly simplified representation of how option contracts work. And while there's a lot more to them, everything you need to know for this video is contained in this example. So let's put it all together and actually describe how to make money from writing covered call options. So to make money with covered calls, you are the seller and you write option contracts and collect the premiums for those contracts. What do you need to have to get started doing this? Well, first off, you need to be covered, and that means you need to own the shares that you're writing the option contracts against. How many shares do you need? Well, at least 100, because that is the minimum lot of shares that one option contract can be written against. As you can guess from what I just said, this all means that there is an investment minimum in order to write covered call options, as you need those 100 shares to get started. If we continue to use Microsoft as an example, that certainly will not be a cheap startup cost, as 100 times $341 per share equals $34,100. So you may want to consider a cheaper stock such as Apple, which is currently trading at around $157 at the time of this video. With Apple, that initial investment will run you $15,700 $700 instead. You generally want to write covered calls on popular stocks, often tech stocks, as these draw a lot of interest from buyers and have significant price movements. The derivative marketplace is not nearly as liquid as that of equities, so it helps to pick shares of companies that see a lot of action and liquidity. So options written on these shares generate interest. Okay, so let's say you have those 100 shares of Apple in your brokerage account, and you decide to write a covered call option contract against them. You can do this right in your account by going to the derivatives menu, and as you request this contract, you'll be asked to select two things. The first is the strike price, and the second is the expiration date. Both are very important, as the goal of writing covered calls is to maximize premium income and minimize the chances of your shares being called away if you're wrong on the price. Let's take these one at a time. The strike price is the price you'd be comfortable selling the stock at. You want this price to be what's called out of the money, or OTM, and that simply means that the chosen strike price is above the expected price of the stock at the time of contract expiration. Then the buyer's options will expire worthless, and you get to keep your premiums without having to part with the actual stock. Picking the right strike price is both an art and a science, and here a good knowledge of the stock's prior price movement and volatility will help a lot, as will a little bit of luck. Let's say for our example with the Apple stock, you picked $165 as the strike price. You then need to pick the expiration date for your options. There are three major classes of options, each one having a significantly different type of expiration date. Standard options expire monthly, while long-term equity anticipation securities, or LEAPs, are longer than 1 year. There are also weekly options, and as the name suggests, they expire weekly. LEAPs are not typical for covered call writing, so you would work with the weeklies or the standard monthly expiration dates. A good starting point is 30 to 45 days into the future, but here you really just want to use your judgment, with the cost of the option premiums playing a major role. You want to look for a date that provides an acceptable premium for selling the call option at your chosen strike price. How much is that? Well, as a general rule of thumb, about 2% of the stock's value is an acceptable premium to look for. Remember, with options, time is money. The further you go out in time, the more an option contract will be worth. However, the further you go out in the future, the more difficult it becomes to predict what may happen. So you may end up losing the price bet. So if we go with the 2% rule of thumb and use Apple stock as an example, pick an expiration date that will give you a premium value that is closest to 2% of the Apple stock value of $157. And that happens to be about $3 per share times 100 shares, or $300. It's the price that buyers will look for as well, and let's say for argument's sake that this value is also equal to an expiration date of about 30 days. Anything further out will get you a fatter premium but a lot more risk. Anything less than that will lower your risk, but at the cost of a smaller premium. Okay, so you've settled on a strike price of $165 and an expiration date of 30 days for your Apple covered call contract. Your broker did all the back-end work to find a buyer for your contract and secured your 100 shares in case they need to be called away. Right off the bat, you made yourself $300, and now all you have to do is wait out the contract. So what can possibly happen next? Well, there are three possible outcomes as the month-long wait winds down and the option contract expires. Let's take a look at all three scenarios. Scenario number one is that the stock price goes down, let's say to $155. This is good only in the sense that the covered call will expire worthless and the stock will not be called away. It's bad in the sense that your stock has gone down in value, but that's the nature of covered call writing. You are, after all, holding the stock and it can decline. However, the profit from selling the covered call may cover the decline if it's only a slight dip. And if it's a solid company like Apple, you're still holding a valuable stock that will likely go up in the future. Scenario number two is that the stock stays the same or just goes up a little bit, but not quite reaching the strike price, such as, for example, $159. Here, the news is good everywhere. The call option you sold will expire worthless, so you pocket the entire premium, and perhaps you've seen some gains of the underlying stock, which you still own, so it's a successful day all around. Scenario Scenario number 3 is that the stock price rises above the strike price, such as, for example, $166. In this case, the buyer is going to want to exercise their options contract and buy your shares at that lower strike price. Your entire stash of 100 shares will be called away by the broker and sold off. So overall, this is a not so good situation, and you've missed the mark in judging the price movement. In order to continue writing covered calls, you would have to take your proceeds and purchase another 100 shares of the same stock, but at the higher current market price of $166 per share, so you lose a bit of money there. Actually $100 to be precise, but as a consolation, you will of course keep your $300 premium, so you still made a profit of $200. Note that in this third scenario, you've missed out on the gains because you had to sell your shares at the agreed upon strike price. This isn't so bad if the shares end up only a little bit above the strike price, and your premium may even cover the loss, but it could be a real heartbreaker if the stock skyrockets significantly above the strike price. Then you will not only miss out on the gains, but if you also want to continue writing covered calls, you'll have to repurchase the stock for significantly more money, so in this case, a loss is guaranteed. As you can see from the previous discussion, the real risk with covered call writing is not from the actual covered calls. They're about as safe as options get. Instead, the risk comes entirely from holding the stock and not benefiting from upside gains if you're wrong on the strike price. As such, it's generally not a good idea to write covered calls on stocks that are overly volatile or are persistently and rapidly appreciating in price. In those cases, just hold the stock and you will benefit far more from the capital appreciation as opposed to profits from the premiums. A better target of covered call writing is a solid stock that is just appreciating a little bit or perhaps spending some time going sideways and not moving in price, although in that case, there may not be much in it for the buyer. So to take a step back and to summarize, covered call writing could be an excellent first foray into options for an investor who's ready to try derivatives. There's of course an initial investment, and this approach does take some skill and is certainly not free money. You do need to be right on the strike price and expiration dates, and you should read up on specific strategies for picking both of those successfully. There are a lot of strategies out there, and it's beyond the scope of this introductory video to really go over all of them. If you become good at covered call writing, you can certainly pull in some solid income from the option premiums. In theory, you can repeat the strategy indefinitely on the same block of stocks, but if you own 1,000 shares of a particular stock, you can write covered calls on all of them in multiples of 100. So if you have 1,000 shares of Apple, for example, you can write 10 covered call contracts in 1 week, and if you write on all of them, you can pull in hundreds of dollars in premiums from just this one batch alone. Some investors do work from home, doing this in fact full time. It's a great way to pull a dividends of sorts out of stocks that don't really pay much of a dividend. And this approach is especially effective in a slightly rising, sideways, or even a slightly down market. And you can expand the idea to write put options and bet on downward movements as well. But that is a subject for another day. Alright, if you've enjoyed this video and found it useful, please be sure to subscribe to the channel and turn on notifications so you don't miss any other investing and money videos just like this one. Thanks for checking it out, and I'll see you guys soon.